Okay, let's unpack this. Imagine for a moment the unseen engine that powers, well, pretty much everything around you. It's the silent, sprawling backbone of the North American economy, often invisible, but absolutely vital. Today, we're taking a deep dive into Union Pacific Corporation, or UNP, one of the titans that, meticulously leaves together our continent's vast supply chains, moving everything from the food on your table to the car in your driveway.
And what's truly fascinating here, I think, is that UNP isn't just some stable utility-like fixture in the landscape. It really stands at a dramatic strategic inflection point right now. So our mission for this deep dive is to meticulously extract the critical nuggets from the investment analysis we've got, helping you understand not just what UNP does, but why it's poised for potentially monumental changes and, what those changes could mean for the broader economy, for global trade, and, for you as a consumer, as a participant in this massive economic machine.
Yeah, exactly. We've got our hands on a pretty comprehensive investment analysis. It pulls back the curtain on everything from UNP's formidable rail network, its intricate financial health, to these game-changing industry trends, like that powerful shift towards nearshoring and, of course, the monumental proposed merger that could fundamentally reshape the entire North American rail industry as we know it.
Right. So whether you're meticulously prepping for, say, a crucial meeting about logistics, or maybe you're catching up on the dynamic shifts within the industrial sector, or even if you're just genuinely curious about the colossal gears that turn our economy, you're going to get a definitive shortcut to being exceptionally well-informed. We promise some surprising facts, insights that'll genuinely make you say, aha, and a perspective that goes far beyond just the headlines.
All right, let's kick things off by laying the foundation. Union Pacific. It's more than just a company. It really is a cornerstone of the North American economy. When you start to contemplate the sheer overwhelming volume of goods crossing this continent, daily raw materials, finished products, agricultural bounty, an astonishing amount of it travels on rail. And UNP isn't just a part of that, it's a colossal, indispensable part, connecting everything from sprawling industrial hubs in the Midwest to the bustling major ports on both the Pacific and Gulf Coast. It's not just transportation, it's like the economic circulatory system.
Absolutely. And when we delve into its core business, the undeniable emphasis has to be placed squarely on its truly irreplaceable network. Picture this. We're talking about approximately 32,500 route miles of rail, meticulously crisscrossing 23 states, spanning the entire western two-thirds of the U.S. Now, what makes this network so vital, so utterly irreplaceable, isn't just its sheer size. It's the immense, almost unfathomable capital cost involved in trying to build anything remotely similar from scratch today. Imagine, if you will, attempting to lay down a new rail network of that scale, now in the 21st century. You'd face astronomical land acquisition costs across thousands of miles, navigating a labyrinth of regulatory hurdles that would frankly make your head spin, and overcoming engineering challenges that are just, well, mind-boggling.
It sounds like a task that would require a budget that makes, I don't know, a space program look like a lemonade stand.
Exactly. It's virtually impossible. And this monumental undertaking forms what economists and strategists call an exceptionally high barrier to entry.
Huh.
It effectively creates this durable competitive moat around UNP's business.
A moat, yeah.
This isn't just about having tracks. It grants Union Pacific significant pricing power. When you operate a network that's the only practical way to move certain goods across vast regions, you have unique leverage. It's not merely a business, it's really a foundational component of the U.S. economy, as deeply embedded as, say, the highways or the power grids.
So on those 32,500 miles of track, what exactly is UNP hauling? Day to day, how does this giant actually make its money?
Well, it's actually built on a pretty well-diversified revenue stream, which is key to its stability. It shields it somewhat from dramatic swings in any single sector. As of full year 2023, their freight revenues were a hefty $22.6 billion. And that's meticulously broken down into three primary distinct commodity groups. The largest of these, making up a significant 37% of revenue, or about $8.2 billion, is their industrial segment.
Okay. Industrial.
Yeah. This covers a vast array of heavy goods, chemicals, plastics vital for almost every manufacturing process, metals and minerals, the building blocks of industry, forest products like lumber and paper, and industrial equipment, heavy machinery, specialized components. Its performance, as you might imagine, is very sensitive to the broader pulse of the economy. It directly tracks manufacturing activity, industrial production indices, construction cycles.
Right. If factories are humming, UNP's industrial segment is humming right along with them. Makes sense. Heavy industries, heavy goods.
Precisely. Then you have bulk commodities. That accounted for a solid 32% of revenue, or $7.4 billion.
Bulk.
Okay.
This is where you find the raw materials that literally feed and fuel the nation. Vital agricultural products like grain, fertilizer, crucial for the food supply, prepared food products, refrigerated goods, and energy products, though primarily coal, it's also refined petroleum. The drivers here are fundamental: the size of the U.S. harvest, global food demand, energy consumption patterns. Now, it's particularly worth noting a significant long-term headwind here: the secular decline in coal.
Yeah, that's been happening for a while.
Right. We saw a substantial 19% decline in coal shipments in 2024 as the energy landscape shifts. But crucially, that was partially offset by a robust 7% increase in grain shipments, which, beautifully illustrates the power of this diversification.
Cushions the blow.
Exactly, when one sector faces challenges.
And what about that final piece, the maybe the most dynamic part of the revenue puzzle?
That would be the premium segment, accounting for 31% of total revenue, or $7.0 billion. This particular segment is widely considered the most service-sensitive part of their business, and for good reason. It competes directly, head-to-head, with the trucking industry.
Right. Trucks versus trains.
Exactly. This segment primarily includes intermodal freight, which is basically the sophisticated movement of shipping containers, truck trailers, seamlessly transferred between ship, rail, truck, and the transportation of finished automotive vehicles. Its performance is very closely tied to consumer spending, international trade volumes, and those highly synchronized automotive production schedules. What's especially fascinating here is that despite some economic weaknesses elsewhere in 2024, international intermodal volumes actually surged by over 19%. Impressive.
Wow, over 19%.
Yeah, this isn't just a minor blip. It powerfully demonstrates that this segment truly acts as a separate and quite potent growth engine, capable of thriving even when other areas might be facing headwinds.
Okay, here's where it gets really interesting, I think, and potentially game-changing for UNP's future. Beyond just the sheer scale of their network, is there a particular strategic ace up Union Pacific's sleeve, something that really sets it apart for long-term growth?
There absolutely is, and it's their unparalleled strategic positioning with Mexico. Union Pacific holds a unique, almost monopolistic advantage. It is the only railroad serving all 6 major rail gateways between the U.S. and Mexico.
The only one.
The only one. This isn't just a nice-to-have. It is arguably the company's single most important long-term growth driver right now. And the why behind this is compelling. It ties directly into this accelerating multi-decade trend of nearshoring. We're seeing a profound shift where companies are increasingly relocating manufacturing their supply chains from distant Asia, particularly China, to Mexico.
So it's not just U.S.-China trade tensions driving this, is it? It feels like it's more than that.
Oh, much more. While trade tensions certainly play a role, the drivers are multifaceted. You've got the demand for more resilient, diversified supply chains post-pandemic, rising labor and shipping costs in Asia eroding margins, geopolitical considerations, even a desire to reduce the carbon footprint of long-haul ocean shipping. Mexico offers geographic proximity, established manufacturing capabilities, increasingly skilled labor. So UNP isn't just passively observing this. They are actively enabling it, strategically capitalizing on
They're
it.
right in the middle of it.
A primary enabler and direct beneficiary. There's significant capital investments in enhancing border crossing capacity, thing expanded rail yards, more efficient customs processes, improved infrastructure. These aren't just routine expenditures. They are critical forward-looking growth expenditures, specifically designed to directly facilitate and capture those burgeoning future freight volumes coming out of Mexico. This strategic foresight provides a powerful offset to those secular challenges, like the decline in coal we mentioned. This is a profound multi-decade play. It positions Union Pacific right at the nexus of a reglobalizing economy.
Okay, so we've clearly seen Union Pacific's unique, almost indispensable position and, how it generates its substantial revenue. But now let's zoom out a bit. What about the wider industry it operates in? And this often debated operating philosophy, precision scheduled railroading, that has utterly transformed it.
Well, the U.S. freight rail industry is, by any measure, a mature, colossal market. Yeah. Generates nearly $80 billion annually. And what characterizes it, perhaps more than anything else, is what we call a stable oligopoly. When you look at Class I railroads, which, for context, are defined by the Surface Transportation Board as those with operating revenues over $490 million annually, you quickly realize there are very few players. Those insurmountable barriers to entry we discussed.
Yeah, the huge costs.
Exactly. The immense capital needed means new competitors simply don't emerge. It's a club with a very exclusive membership.
So who are the titans of this exclusive club, specifically in the U.S.?
In the western U.S., it's essentially a powerful duopoly, Union Pacific and BNSF Railway, which is owned by Berkshire Hathaway. These two giants control the vast majority of transcontinental freight lines in that enormous region. They effectively split the market.
Okay. And in the East?
In the eastern U.S., you have two other major players, CSX Corporation and Norfolk Southern. Then, adding another layer of complexity and competition, the major Canadian railroads, Canadian National CN, and Canadian Pacific Kansas City, CPKC. They're also significant competitors, particularly for those crucial north-south corridors connecting Canada, the U.S., and Mexico, brings even more competitive dynamics into play. And all of this, importantly, operates under the close economic regulation of the Surface Transportation Board, the STB.
Right, the STB.
It'll wield considerable power, overseeing everything from freight rates to service standards and, critically, greenlighting or denying major mergers.
Now, for the past decade or so, this concept, precision scheduled railroading, or PSR, it's completely and controversially reshaped how these railroads operate. It sounds hyper-efficient, but it hasn't been without its scars, has it?
You're absolutely spot on. PSR was pioneered by the legendary and often divisive late executive E. Hunter Harrison. It fundamentally shifted the entire operating philosophy of the industry. Instead of the old model where trains moved whenever they were full or a crew was ready, PSR focuses on the granular, almost meticulous disciplined movement of individual rail cars on a fixed, passenger-like schedule. Think less chaotic freight yard, more carefully choreographed dance.
Okay, like clockwork.
That's the goal. The core objectives are clear. Maximize every single asset's utilization, run longer, heavier trains with fewer locomotives and rail cars, do more with less, relentlessly minimize dwell time, that's the time cars spent idle in yards, not making money. And, perhaps most importantly, drive down the operating ratio. That's the golden metric. Operating expenses as a percentage of revenue. Lower is better.
And financially, it certainly delivered for the railroads, didn't it? Like turning these giants into lean, mean, cash-generating machines.
It truly did. For the industry, PSR has been a resounding financial success. Dramatic improvements in operating margins, free cash flow, substantial shareholder returns across the board. Companies that adopted PSR saw their valuations soar. However, you're absolutely correct. This success came with significant controversy and criticism. Shippers, the customers, frequently complained of poorer, less flexible, often less reliable service. Imagine adapting your supply chain to a rigid, fixed schedule.
Tough.
Yeah. Labor unions, too, raised serious concerns. Safety risks from longer trains, fewer crews, and, of course, substantial workforce reductions. This intense, almost obsessive focus on efficiency, at times, inadvertently reduced the network's resilience.
Made it brutal.
Exactly. Made the entire system vulnerable to widespread disruption when faced with unexpected surges, external shocks like weather, or internal challenges like labor shortages. This fragility was glaringly evident across the industry in 2022 and 2023. It showed that hyper-efficiency, pushed to its limit, can indeed come with a dangerous degree of brittleness.
So rail doesn't just compete with other railroads, it goes head-to-head with trucks, often for the same freight. And this intense, sometimes brutal competition is driving a new wave of industry consolidation, it seems.
Exactly right. When you compare rail and trucking side by side, rail has a clear advantage in fuel efficiency and cost effectiveness, especially for heavy bulk stuff over long distances. Get this statistic. A train is, on average, 4 times more fuel efficient than a truck. It can move 1 ton of freight over 470 miles on a single gallon of fuel.
Wow, 4 times. That's huge.
It's a powerful edge for certain cargo. Trucks, on the other hand, offer unparalleled flexibility and faster transit times, better for shorter haul, time-sensitive freight, or direct door-to-door. Historically, the U.S. rail industry has seen a long, dramatic history of consolidation, leading to the current oligopoly. We saw this most recently and significantly with CPKC's acquisition of Kansas City Southern in 2023, a landmark deal.
Right, the first Canada, U.S., Mexico single line.
Exactly. That created the very first single-line network connecting all 3 countries, a game changer.
And that, in a way, really set the stage for something even bigger, didn't it? It almost made the next strategic move feel inevitable.
It absolutely did. The widespread adoption of PSR fundamentally altered the competitive dynamics. With all major players rigorously pursuing similar strategies, cost control, asset efficiency, the primary basis of competition shifted. It wasn't just about distinct service offerings anymore, but more about the sheer quality of operational execution. Who could run PSR better? This evolution brought us directly to the proposed UNP-NSC merger. This monumental deal can be seen as a direct strategic consequence of PSR reaching a point of diminishing returns. After years of relentless cost-cutting, the incremental benefits of further internal tightening became smaller, harder to achieve, more risky. The next logical step for a quantum leap in value isn't purely internal optimization anymore, it's through transformational expansion of the network itself. The merger's rationale, heavily weighted towards revenue synergies from creating a superior single-line service, signals a clear pivot. From pure efficiency to ambitious growth through network dominance, building a better, faster, more competitive railroad that just can't be replicated.
Okay, this brings us squarely to the biggest headline for Union Pacific, this proposed merger that could completely redraw the map of North American rail, fundamentally change how goods move. Let's dive into what that truly means. This is the big one. Announced July 2025, UNP's proposed merger with Norfolk Southern isn't just another deal, it's genuinely transformative, almost epoch-making.
It absolutely is.
Yeah.
The ambition is breathtaking. The core strategic rationale, nothing less than creating the very first single-line transcontinental railroad in U.S. history. Just pause and imagine that. A seamless, uninterrupted connection. UNP's dominant western network, Pacific to Mississippi, and NSC's extensive eastern network, Gulf Coast to the northeast industrial heartland.
Wow. One line, coast to coast.
Exactly. The key benefit, eliminating those costly, time-consuming, often congested interchanges at bottlenecks like Chicago, Memphis, New Orleans. By forging one continuous unified network, the combined entity could offer service that's faster, more reliable, and more cost-effective, making it vastly more competitive with long-haul trucking, potentially cutting cross-country transit times by a remarkable 1 to 2 full days.
1 or 2 days, that's a massive leap in logistics efficiency.
Huge.
This is clearly no small deal, financially or strategically. What are the sheer financial implications, and how ambitious are those projected benefits?
Financially, it's absolutely massive. The transaction values Norfolk Southern at roughly $85 billion. That was about $320 per share at announcement, a significant 25% premium. It's structured at 72% stock, 28% cash, balancing immediate cash outlay with shared future equity upside. If this goes through, the combined company would be an undeniable behemoth. Pro forma revenues around $36 billion annually, enterprise value exceeding a staggering $250 billion.
A $250 billion company.
An unrivaled giant in North American logistics.
And the synergies they're projecting sound just as ambitious. Almost too good to be true.
They are ambitious, no doubt. Management laid out projected annualized synergies of $2.75 billion, aiming to hit that by the third year post-closing. What's absolutely crucial here is the focus of these synergies. A significant chunk, $1.75 billion, is expected specifically from capturing entirely new business.
New business, not just cost cuts.
Right. Converting freight currently moved by trucks onto rail. Penetrating underserved or new markets accessible with a single-line offering. This is a clear, aggressive strategic shift towards leveraging the combined network for growth. An additional $1.0 billion is projected from operational efficiencies, traditional cost savings. All told, the estimated total value creation from synergies alone, over $30 billion, suggests immense upside potential.
But as you said earlier, this is far from a done deal. The path to regulatory approval sounds like a gauntlet.
That's truly an understatement. This transaction faces an incredibly rigorous review by the Surface Transportation Board, the STB. Under their stringent 2001 merger rules, the bar is exceptionally high. A major rail merger must be proven to genuinely enhance competition and be unequivocally in the public interest.
Enhance, not just not harm.
Exactly. A much higher standard. The Notice of Intent is filed under docket number FD 36873. Widespread, vociferous opposition is absolutely expected. Guaranteed, almost. Shippers worry about reduced competition, higher rates, fewer options. Labor unions worry about job losses, safety. Competing railroads like BNSF and CSX will seek to protect their positions, maybe advocate for onerous conditions.
So everyone has a stake.
Oh yeah. The regulatory review itself is lengthy, statutorily defined, highly public. Targeted closing date isn't until early 2027. It's not just a marathon, it's a high-stakes obstacle course.
Now, if we connect this back to the bigger picture, especially that nearshoring trend, this merger isn't just about scale, is it? It feels like it's about strategically capitalizing on one of the most important emerging trade lanes on the planet.
That's precisely it. The merger and nearshoring are deeply, almost inextricably intertwined. This isn't just simple horizontal consolidation. It's masterfully designed as a strategic vertical integration of the North American supply chain. The grand vision. For UNP to capture the full, high-margin revenue stream from goods made in Mexico's burgeoning industrial centers.
All the way through.
Exactly. With a single combined network, they could transport these goods seamlessly, one continuous line, from Mexico to the major consumer and industrial markets in the eastern U.S. Think about the current process. Costly, time-consuming interchanges between UNP and an eastern carrier introduces delays, costs, makes trucking competitive.
Right.
A single integrated network, however, creates a powerful one-stop Mexico to East Coast logistics product. This transforms the merger from simple consolidation into a strategic maneuver to fundamentally dominate one of the most important, rapidly growing emerging trade lanes in the world. It's a truly bold, far-sighted bet.
Okay. This vision is incredibly bold, but it also stands on the back of UNP's recent financial performance and its demonstrated operational discipline. Let's dig into those numbers, understand the roller coaster they've navigated to get here. So what's the story with UNP's financial health over the past few years?
It truly has been a bit of a roller coaster, yeah, but one that ultimately reflects strong underlying resilience and management's adaptability. Looking at the 5 years, 2019 to 2024, operating revenues stayed remarkably stable, generally around $24 billion, fluctuating with the economy. We saw that dip in 2020 due to COVID impacts on supply chains, demand,
Understandable.
followed by robust growth in 21, 22 as things roared back, pricing power was strong. 2023 saw a modest 3% decline to $24.1 billion, mainly lower fuel surcharges, slightly fewer carloads. But they showed a slight recovery to $24.25 billion in 2024, signaling stabilization.
And the operating ratio, that critical PSR metric, how did that perform through these turbulent years? It's like the financial heartbeat, right?
That's where the story gets really compelling. UNP made huge strides early on, drove their OR down from 60.6% in 2019 to an outstanding low of 57.2% in 2021.
57.2, that's impressive.
A fantastic achievement, hyper-efficient operation. But then, the inflationary pressures of 22 and 23 hit hard. Fuel, labor costs, difficult to pass on immediately. That caused the ratio to deteriorate significantly, back up to 62.3% in 2023. A tough operating environment.
Ouch.
But here's the key insight. The subsequent strong improvement back down to 59.9% in 2024 powerfully demonstrates a successful management-driven effort to regain control, enhance efficiency. And crucially, throughout this whole period, despite shocks and fluctuations, UNP remained an incredibly powerful cash generator. Cash from operations consistently over $8 billion annually. For a capital-intensive industry like rail, that consistent, robust cash flow is vital, testament to the business model's strength.
Beneath those yearly numbers, you mentioned a really significant operational inflection point, especially late 2023. What does that tell us about their ability to respond?
It tells us a tremendous amount. Leadership responsiveness, organizational capability, the noteworthy divergence between full year 23 results and Q4 23 performance, not coincidental. This sharp turnaround coincided directly with Jim Vina's return as CEO in August 2023.
Ah, Vina, the PSR.
Exactly, renowned PSR practitioner. His return clearly signaled a renewed, intense focus on operational excellence. In that crucial Q4 23, we saw sharp, double-digit improvements in key metrics. Freight car velocity up 14%, locomotive productivity up 14%, workforce productivity up 4%.
Strong finish.
A very strong, management-driven finish. It established a much stronger operational run rate heading into 2024, which then directly translated into that impressive 240 basis point OR improvement for full year 24. This wasn't just cyclical recovery. It was a clear, decisive, management-driven operational turnaround.
And how does that rebound, specifically that 2024 operating ratio, stack up against their competitors, the other big U.S. and Canadian players?
When you analyze the 2024 data, UNP's 59.9% operating ratio was, remarkably, the best among its direct U.S. competitors. Even more impressively, it was on par with the historically efficient Canadian railroads, often seen as the gold standard.
On par with the Canadians?
Yeah. This superior efficiency translated directly into a visibly higher return on invested capital for UNP, powerfully underscoring the effectiveness of their model under current leadership. It shows they're not just improving, but excelling relative to their peers.
Okay, despite these strong fundamentals, impressive operational improvements, the last few years weren't exactly smooth sailing for the entire rail industry. What were some of those key headwinds that really tested the system?
You're absolutely right. 2022 to 2024 was exceptionally challenging. Brutally exposed vulnerabilities in prevailing operating models across the industry. First, major cascading supply chain disruptions. Post-COVID import surges led to severe port congestion. That quickly cascaded inland. Bottlenecks everywhere. Railroads struggled with equipment shortages, especially chassis for intermodal containers. Full yards, significant delays. UNP's network faced such acute congestion, it dramatically increased its use of embargoes restrictions on new traffic, from just 27 in 2017 to over 1,000 in 2022.
1,000 embargoes. Wow.
Yeah, not a minor issue. A clear signal of widespread service meltdown. Drew sharp criticism from shippers from the STB.
And the labor situation was incredibly tense too, wasn't it? Almost brought the nation to a halt.
Extremely so. Labor relations and shortages became critical, almost existential. Aggressive workforce reductions under PSR left railroads with insufficient staff for the freight rebound. Chronic crew shortages. The contentious industry-wide labor negotiations in 2022 were so fraught, they brought the nation to the brink of a debilitating rail strike.
Right, I remember that. Required government intervention.
Exactly. Catastrophic economic consequences averted. But workforce availability remains a persistent, closely watched risk. On top of that, significant inflationary pressures in 22, 23, fuel prices soared, lagged recovery through surcharges. The new National Labor Agreement meant substantially higher wages, benefits. Material costs like steel, timber rose sharply. These pervasive pressures were the primary cause of UNP's OR deterioration from that impressive 57.2% up to 62.3% in 2023.
And all this turmoil didn't escape the regulators' attention. They seemed to take a more assertive stance.
Absolutely. A clear trend of heightened regulatory scrutiny. The STB adopted a much more activist, almost interventionist stance. Public hearings demanding detailed performance data, openly considering new rules like reciprocal switching to foster competition. All these challenges, supply chain shocks, labor, inflation, scrutiny, powerfully expose the inherent vulnerability of the hyper-efficient, lean PSR model. The intense focus on minimizing resources, crews, locomotives, cars created a system with insufficient buffer capacity.
Made it brittle, like we said.
Exactly. Brittle. Unable to absorb shocks or demand surges without widespread disruption. What's truly insightful is UNP's subsequent strategic shift, explicitly including maintaining a resource buffer. It's a direct acknowledgement of painful lessons learned, a recognition that pure efficiency without a safety margin can lead to severe fragility.
So after navigating those stormy waters, how is Union Pacific responding now? How are they doubling down on their operational strategy for the future?
They're doubling down with a renewed, almost zealous focus on PSR, now framed under this holistic mantra: safety, service, and operational excellence. Jim Vina's return wasn't just personnel, it unequivocally signaled his commitment. Their current key objectives are meticulously targeted, minimizing in-transit work events, car classifications to keep freight moving smoothly, relentlessly reducing dwell time for idle cars, operating longer, heavier trains for maximum productivity, and maintaining a balanced network resources positioned optimally to meet demand without bottlenecks. The sharp improvements since late 23, direct, tangible results of this renewed PSR rigor.
And technology, of course, must be playing a crucial role in making this complex, efficient system actually work in practice, right? Kind of a glue holding it together.
It's absolutely critical. Technology is the unsung hero, the indispensable enabler. UNP is investing significantly in advanced tech to enhance safety, improve efficiency, elevate the customer experience. For instance, automation and predictive maintenance. Deploying cutting-edge autonomous track geometry cars to inspect tracks without human crews enhances safety significantly. Using sensor-based systems to predict equipment failures before they occur improves efficiency via proactive maintenance, reduces costly breakdowns. Yeah. On the digital customer experience front, developing around 40 APIs allows customers to seamlessly integrate UNP's real-time tracking, shipping data into their own systems. Tools like the UPGo mobile app streamline intermodal operations, cut gate times, improve truck driver turnarounds.
And their ongoing efforts to modernize the fleet must be a big piece too, especially for fuel efficiency.
Precisely. Substantial strides in fuel efficiency and fleet modernization. Investing heavily in new, more fuel-efficient Tier 4 locomotives, lower emissions. Actively testing next-gen tech, like hybrid battery electric locomotives, pushing boundaries. These efforts have yielded impressive results. UNP has improved overall fuel efficiency by 22% since 2000, reduces operating costs, lowers carbon footprint, 22%, not bad. The overarching analysis here, technology isn't just incremental gains, it's the crucial enabler, the glue of the broader PSR strategy. A common criticism of PSR is its rigidity. These digital tools directly address that tension, Real-time visibility, predictive insights empower customers to manage their supply chains more effectively around the railroad's fixed schedules. Mitigates inflexibility. Internally, predictive tech allows them to run a leaner network with more confidence, identify issues before they become major disruptions. This fusion of rigorous operational discipline with cutting-edge tech lets UNP pursue PSR's cost benefits while striving for reliable, predictable service. To retain customers, fiercely compete with trucks.
Okay, we've thoroughly examined the immense power of UNP's network, its transformative operational philosophy, the monumental bet on the Norfolk-Southern merger. But with great opportunity often comes equally great risk. What stands out to you about the most significant potential downsides, the challenges ahead?
That's a vital question, maybe the most critical when evaluating their future. When we categorize the risks, several distinct yet interconnected areas pop up. First, business and economic risks. UNP has inherent cyclical exposure. Freight volumes are highly correlated with industrial agricultural cycles. A significant downturn, recession, weak harvests directly impacts revenue profitability.
Makes sense.
There's also intense duopolistic competition from BNSF out west, a formidable, well-capitalized rival. And looking further out, the long-term disruptive threat of autonomous trucking, still nascent but could eventually erode rail's long-haul cost advantage, force a strategic rethink, and of course that persistent headwind from secular coal decline, a fundamental challenge they must continue to offset.
And then, looming over everything, those regulatory and legal challenges seem especially acute given the scale of this proposed merger.
Those are perhaps the most immediate and impactful risks, yeah. The merger approval risk is, without doubt, the single largest, most immediate risk to the entire investment thesis.
Yeah.
The STB holds immense power. They could block it entirely if it's not deemed in the public interest.
Oh.
Or approve it, but impose extremely onerous conditions, forced divestitures, extensive trackage rights for competitors, things that would severely diminish the deal's benefits and rationale.
Gut the deal, essentially.
Could happen. Beyond the merger, there's the pervasive risk of heightened regulatory oversight industry-wide. After recent service struggles, the STB is more activist. Potential new rules, like reciprocal switching, could limit pricing power or operational flexibility for all railroads. Plus, as a transporter of hazardous materials, UNP constantly faces environmental and safety liability risks. Significant financial liability, reputational damage from accidents, we've seen that elsewhere. Climate change risks, too severe weather impacting infrastructure, stricter emissions regulations, all factor into long-term planning.
What about the internal operational risks, the day-to-day challenge of running such a massive, complex network?
Also highly significant. Requires constant vigilance. There's always inherent PSR execution risk. As 2022 painfully showed, failing to balance lean resources with fluctuating demand can lead to rapid cascading network meltdown, severe service disruptions, regulatory intervention.
Right, the brittle network problem.
Exactly. Labor relations are another critical risk area. Roughly 84% of UNP's workforce is unionized. Future contract negotiations leading to work stoppages. Severe, immediate impact on operations, customers, the national economy. Finally, increasing reliance on tech means cybersecurity is a growing, evolving risk. Operational disruption, data theft, infrastructure compromise.
What's fascinating here is that the merger itself creates this unique, almost paradoxical risk profile for UNP, a sort of high-stakes dilemma.
It truly does. A classic high-stakes double-edged sword. Consider this. If the merger fails to get regulatory approval, UNP faces the strategic risk of being competitively disadvantaged in a potentially reconsolidated industry. Especially if a rival merger, say BNSF and CSX, were to proceed later, UNP would be the only major U.S. railroad without a true coast-to-coast network.
Left behind.
Playing competitive catch-up. Missing out on those long-haul, single-line revenues. Conversely, if the merger succeeds, the new, much larger Union Pacific immediately faces immense integration risk. Merging two colossal organizations, distinct cultures, systems, workforces is a monumental undertaking, and it would almost certainly become the subject of permanent, heightened regulatory and political scrutiny.
Under the microscope permanently.
Absolutely. Any future service disruption, safety incident, pricing action likely triggers a swift, strong response from Washington. New regulations, more oversight. In effect, they'd be trading a degree of current operational and commercial autonomy for a significant increase in scale and network reach, placing themselves squarely under that perpetual regulatory microscope. It's a fundamental strategic trade-off.
So how does all this potential change, this risk, fit into Union Pacific's long-standing and, frankly, very strong commitment to shareholder returns?
Under its standalone strategy, UNP has had a historically very disciplined capital allocation approach. typically around $3.4 billion annually in CapEx. Balancing network maintenance with targeted growth projects, they boast an exceptional, almost unparalleled track record of dividend payments. 123 consecutive years.
123 years.
Yeah.
Incredible.
19 consecutive annual increases,
Yeah.
healthy payout ratio, 46-50% of earnings. They've also been consistently aggressive with share repurchases. Target $4.0 to $4.5 billion for 2025, returning significant cash.
So how does the proposed merger fundamentally alter that otherwise very clear shareholder picture?
It creates a significant, albeit temporary, shift in that capital allocation strategy. Upon closing, share repurchases would be paused. Necessary first to finance the substantial cash portion of the deal. Second, to strategically manage the increased leverage. Debt to EBITDA projected to rise from 2.5x to 3.3x at closing.
Okay, so pause buybacks, manage debt.
Right. The immediate focus post-merger would be deleveraging. Target 2.8x debt to EBITDA by year 2. However, and this is the critical upside, the long-term capital return potential is projected to be substantially enhanced. The combined entity is forecast to generate roughly $12 billion in annual free cash flow by year 3 post-merger.
$12 billion a year.
This powerful, amplified cash generation could enable resuming a very large-scale share repurchase program, potentially exceeding $10 billion annually, all while simultaneously supporting continued, robust dividend growth.
So it really boils down to a distinct trade-off for shareholders then, near-term certainty for potentially much larger long-term growth.
Precisely. Shareholders are asked to forego the certainty, the immediacy of near-term buybacks, accept a defined period of higher leverage. In exchange, exposure to the potential for owning a company with a structurally higher level of long-term earnings power, significantly enhanced free cash flow generation. But, and this is the crucial contingency, the viability, the attractiveness of this trade-off is entirely dependent on securing regulatory approval, and then, just as importantly, successfully executing the incredibly complex integration to actually realize those ambitious projected synergies.
A lot of ifs.
A lot of ifs.
Big ones.
Given this incredibly complex web of opportunities and risks,
Right.
how does the market currently view Union Pacific? What's its valuation telling us about what investors are pricing in right now? Well, as of mid-2025, UNP trades at a trailing PE ratio around 19.1x, EBITDA multiple around 13.2x. These valuations are broadly in line with its own historical averages and also with peers like Norfolk Southern, CSX. The key takeaway here: the fact that UNP's valuation isn't currently at a significant premium suggests the market is in fact pricing in a considerable degree of uncertainty around the Norfolk Southern deal.
Makes sense. They're waiting.
Exactly. Clearly in a wait-and-see mode, not fully baking in the success of this monumental transaction.
So in a way, it creates an asymmetrical risk-reward profile for investors, doesn't it?
Exactly. This dynamic creates a truly asymmetrical risk-reward profile, almost like a fascinating options play. If the merger is ultimately approved with manageable conditions, significant potential for substantial earnings accretion, a positive re-rating of the stock's multiple, those massive synergies unlocking tremendous value.
Big upside potential.
Huge. Conversely, if the deal fails, the valuation is likely supported by the strong underlying fundamentals, powerful cash flow of the standalone business, potentially cushioning the downside. In essence, for investors looking at UNP today, it kind of resembles buying a call option on the merger's success, with the underlying business providing a pretty robust safety net.
So what does this all mean? We've thoroughly unpacked Union Pacific's indispensable network, its transformative operational philosophy, and the monumental bet it's making on the Norfolk Southern merger. UNP's role as a critical artery for North American supply chains is clear. Its embrace of PSR drove incredible efficiency, but also revealed vulnerabilities. And now, this proposed merger represents an immense bet on network superiority for its future, aiming to capitalize on that powerful nearshoring trend to fundamentally rewrite the rules of logistics.
Yeah, this deep dive into Union Pacific really reveals far more than just an investment case. It highlights these profound strategic shifts happening across core industries that, quite literally underpin our daily lives. You've seen how global supply chain realignments, the evolving philosophy of operational efficiency, the intricate regulatory landscapes, how they all converge and interact to shape the trajectory of a company that is just foundational to our economy. It's a fascinating, complex look at the colossal gears that tirelessly turn the world.
And here's a final provocative thought for you to maybe mull over. Union Pacific's proposed merger with Norfolk Southern isn't just about two companies combining assets. It's a profound test case for the very future of critical infrastructure and global trade in North America. As companies chase resilience and efficiency by bringing manufacturing closer to home, will a consolidated, hyper-efficient rail network be the ultimate enabler? Or will it be a system so critical that its very success creates an unavoidable vulnerability to economic and regulatory pressures? What if the most efficient system, by its very nature, is also the most fragile? Keep a very close eye on this space. The outcome will be absolutely fascinating to watch unfold. We genuinely hope this deep dive gave you that well-informed edge you were looking for and maybe a few aha moments along the way.
Yeah.
Until next time, keep digging, keep learning,